Hey everyone, it's Kirk here again at Option Alpha. So in this video, we're going to go through Iron Condor Strategy 101. We're going to talk about the setup, profit zones, risks, how you can lose money, how you can make money, and automation. And then we're also going to show you some live examples of trades that I placed and also maybe walk through a live trade right now as well. So first of all, let's go through the setup of an Iron Condor. So if you're a brand new trader, newbie trader, you don't know what an Iron Condor is, we're going to walk through the whole thing here so you understand it start to finish, step by step. And then you can start to give yourself some tools for finding these Iron Condor trades. So Iron Condor basics. The basics of the Iron Condor is that essentially it's a multi-leg strategy. What that means is that it just has a bunch of different option contracts that when combined together create a unique payoff diagram. So an Iron Condor essentially is two vertical spreads that you put together. So it's essentially a bull put spread and a bear call spread. You're essentially selling these two spreads. You can think about them as spreads or even strangles and straddles put together. And all the options have the same expiration date. And when you combine all of these different option contracts, you get this payoff diagram that's a pretty neutral looking payoff diagram. So the main difference between an Iron Condor and a vertical spread is that an Iron Condor has four legs. You've got to have four contracts, two puts, two calls, while a vertical spread only has two legs. Again, I'll go through this here in a second with some examples, but that's kind of the main difference. Now, they're typically set up as neutral strategies where the goal is to make money if the underlying asset's price stays within a specific range between now and expiration. And essentially you want that range to be between what's called your short put and short call legs. And the Iron Condors are entered for a net credit. So you'd be able to keep the entire credit, the entire premium as profit or income for this position. Okay, so here's what it kind of looks like. Essentially what you have, or let me actually go here first. This is an Iron Condor payoff diagram. This is what it looks like when it's fully built out, when it's fully complete. And so essentially what you have here is you have these four legs, which are really these four pivots in the actual payoff diagram. So wherever you see a pivot in an option payoff diagram, that is essentially one of the legs of the contracts. So you would have four legs here in this Iron Condor. It creates this kind of humped rhombus type looking payoff diagram. And inside here, this is your profit zone. This is where you want the stock to stay. You want the stock to be range bound or neutral. Let's say that we entered this position when the stock was trading around $100. And so essentially what we're doing is we're giving the stock a range to trade between our break even here, which is 93, and our upper break even here, which is 107. If that stock stays between that range, then we make money on this trade. We would lose money, of course, if the stock moved outside of that range. So if the stock was, let's say out here, right, it moved down below 93 or moved up above 110 or 107, I'm sorry, then we would lose money. So essentially, like we said, Iron Condors work well if the stock stays generally range bound. That doesn't mean that it can't go up, that it can't go down. It just has to stay within the range that you've built out on this strategy. Now, Iron Condors are essentially a combination of two strategies put together. So the two strategies that I mentioned before are the bull put spread and the bear call spread. That's essentially two different credit spreads. So here you've got your bullish put spread where you're selling a put option, then buying a put option at a lower strike. When you combine that together with a bear call spread where you're selling a call and then buying a call at a higher strike, you essentially, again, get this Iron Condor shape. Another way that you can think about Iron Condors is essentially the combination of a short straddle, which would be, short strangle, which would be this position. This is a pretty popular position for traders, although the downside with a short straddle is that you have unlimited and undefined risk. And so the problem is that you're just selling two option contracts here. You do take in a really, really big premium when you do this. And that's the upside to doing a short strangle. However, I think that the downside is significantly more, which is you've got max undefined risk and unlimited risk, which means that the stock can continue to go up or continue to go down forever, and your losses are not capped. So what you do with this type of position is that you essentially are going to buy that extra leg out here to define your risk. So that's what you do with an Iron Condor. Is essentially, it could be thought of as two put spreads. or to credit spreads, or it could be thought of as a short strangle with protection. You're buying protection, spending a little bit of money to buy that protection. And what that eventually does is it caps your risk. So you have defined risk, and that makes it a lot easier. So if you look at this one right here, you can see this short strangle here takes in a credit of about $500. The break evens are at 90 and then 110. And so what you do if you were to buy that protection, you'd spend a little bit of money to buy protection. Maybe now your max profit is down to $200, so you spent some money to buy protection. Your break evens moved in just a tiny bit to 107 and 93, but now your max loss is capped at $300. Significantly better setup than going with the undefined risk scenario. So that's why people love iron condors. That's why I trade a lot of iron condors personally, because you have defined profit, defined risk, you know exactly what you're working with, and the stock just has to stay range bound, which is why I generally like it. All right, so let's talk about profit zones and risks. We already kind of went through it a little bit here, but I'm going to give you a different visual for this because I think it might help out. But when I think about an iron condor, I think about the iron condor payoff diagram, not looking like this, which is how you would typically see it, and you would typically see it in a lot of broker platforms, even Option Alpha. We show it like this in the payoff diagram, just what everyone is used to. But visually in my mind, I think about an iron condor payoff diagram as actually looking like this. And this is what you can think of when you think of an iron condor and the profit zones and risk. So here we have a stock that's trading. We don't know where the stock is going to go, right? So right now the stock is just somewhere here. Let's call this around $100, right? That's where the stock is trading right now. It's about $100. And so we set up our iron condor by executing all of the legs of the position. So for example, we would sell the 105 strike call option. We would buy the 110 strike call option, and that would give us our defined zones above where the stock is trading. So essentially we want the iron condor to trade below this range. On the lower side, the put side, we would sell the 95 strike put, and then we would buy the 90 strike put. All of this combination of buying and selling would eventually get us our credit. Our total credit on this position might be something like $200. That $200 is the most we can make, and then the difference between the strikes less the credit is the amount of money we can lose, which is $300. So again, to get your max risk, you're going to take the width of the spread, in this case, the width of the difference between selling a contract and buying the other contract. That difference here is $5. You subtract from that $5 your $200 net credit, and that $200 net credit gives you a total risk of $300. So that's how you get to that max loss. So down here, you can see we've got our lower zone with our break evens at 93 and 107. That's just the short strikes, adding and subtracting the total credit that we received of $2 from the short strikes. So you subtract 95 minus 2 gives you 93, and 105 plus $2 credit gives you 107. That's your break evens. That's that dotted line here. And so now what you have is you have your profit zones and your risk zones. Ultimately, we want the iron condor, or the stock itself, as it gets through expiration, as it trades, it wants to stay in this zone. This is called our out of the money zone. This is our max profit zone. The reason it's called our OTM, or out of the money zone, is because our strikes are out of the money compared to where the stock is trading. So if the stock is trading right here at expiration, right at $100, then that means that our strikes are out of the money, here. That means that it didn't violate or challenge our position. So we keep the entire premium as profit. This is the ideal situation, is we want the stock to land in this zone. Now, if the stock does go beyond our expectations, then it would go in the money, which means that the stock itself is going to start trading in the money to our strikes. It's going to start trading beyond one of our strikes. It could go lower, it could go higher, right? But if it goes outside of this range, that is where we get into our max loss scenario. That's not the ideal situation. It's of course going to happen if you trade iron condors. You just need to know how that kind of works. So as the stock is generally trading, and this is how I kind of think about it, we want the stock to stay in this range. It could go down, it could go back up. As long as it doesn't go outside of this range, we would be okay. So let's say right now that the stock actually ends expiration maybe right here. And you can see as it was trading, It kind of dipped into that max loss zone just for a little bit. And then at the end of expiration, let's say the first expiration, the stock ended right here. Maybe we entered the position, it was trading at 100. Now it's trading at 98. Well, if this is the case right now, then we would still receive our max profit. Remember, our max profit is as long as the stock is trading in between the short strikes, then we get the entire premium and credit as profit. So in this case, if the stock ended at 98, then we would still collect our entire max profit. Let's go through another example here. So let's just keep dragging this over. Let's say we entered another iron condor, but this time, let's say the stock went up really big or whatever the case is. Let's just move it up and say it went up here and the stock landed at expiration and it was up here. Maybe it was at like 111 or 112, somewhere up there, right? If that's the case, then we're at max loss because the stock moved outside of our expected zone. That's not what we wanted it to do. We wanted it to stay range bound, but it moved outside that zone. Now let's say that we go through more expirations and the stock comes back inside to our zone and now it lands back in here. Again, we would have a profit on this trade. So you can see how it kind of moves with the stock. Obviously, I'm moving the chart around just to kind of show you a bunch of examples. But the ultimate goal here, of course, with iron condors is that the stock ends expiration inside of our max profit zone. If you were to enter a position here, for example, like right around $100, you enter this position, the stock could go above and challenge your strikes on this side, but it doesn't mean that the position is going to be a loser. It's only what happens at expiration. So if at expiration it comes back down and it lands inside of that zone, then that means that you can win on this trade. That's why iron condors are so cool, because you can give them some different times, some different wings and widths, things that we're going to go through here in this video still, but it gives you an opportunity to kind of craft this opportunity where the market can move and you can still make some money on the position. All right, so let's go through a couple examples here so you can see how to build out an iron condor yourself. So inside of Option Alpha, if you go into your position tab, we can actually just build out an iron condor straight from a new position screen. So if you want to build out an iron condor from scratch, you don't want to use anything else, you just know exactly what you want to find. You go in here, type in the symbol that you want to trade. We're going to go down here to iron condor, and then we're going to select the expiration that we want. Now, if we go out to a further expiration, that means the iron condor might have more premium, but it also means that it might not decay at a really fast rate, which means that the P&L is going to stay generally very slow moving until you get closer to expiration. If you choose expirations that are closer in time, so 0, 1, 2, 5 days out, 10 days out, you're not going to get as much premium on those positions. They're not going to pay a lot because they expire really, really soon. And you're going to see that those P&L numbers for those positions are going to fluctuate pretty rapidly. So it doesn't mean that they're bad opportunities. It just is a difference of how they work. So let's just go out here to the monthly contracts, which are May 16th. And then what we're going to do is we're going to kind of build out our iron condor. So notice here, you've got your 4 legs that you need to build out. You've got your long put, your short call, and your long call. Typically what I do is I start out with my long put option. I'll open up the selector for the long put option. You can see this is our option pricing table here. You've got all the strikes here down the left-hand side. And then you've got the last price of the actual security. So in this case, SPY's last price was $5.35 here. So what we want to do with our long put is go lower on the strikes. So our puts are going to be lower. So we'll go down here somewhere pretty low. Maybe let's go down here to the 500 strike put. And once we select that, you can see it automatically jumps over, and now we can immediately select our short put strike. So we've tagged this one for now as our long strike. This is our 500 strike long put. And then we can go in here and we can do something like, all right, let's do the 502. So we're going to do a $2 wide position here. We'll do the 502. It jumps over to the call side now immediately. So now you've selected your short put. It goes to your short call strike. We're not going to do the short call strike at the same level. We're going to do it much, much higher than where the stock is. So we're going to drop that last price down here. We'll go much higher here. So we'll go something like, let's do 558. And then we'll last do our 560 here. And we can just kind of mess around with this as we go. But now that we have this position kind of built out, what you're going to see is you're going to see the payoff diagram be created for you on the fly here in this position screen. And so now you have your strikes, you have your call strikes, so your two different sides. So this is your full iron condor legs here. And what's cool about it here is that you've got all this additional information pre-calculated for you. So you've got your net credit for the different positions right now. You've got your days until expiration. This contract expires in 22 days. You've got your break-even prices. So we automatically calculate those break-even prices based on this mid-price credit. You've got your maximum potential profit and your maximum potential loss. And what we also do in here is we also calculate these additional metrics, which are really important, which is your reward to risk ratio, your alpha metric, your expected value on this contract, your probability of profit, your probability of max profit, so your probability that stays directly in between your short strikes. The probability of profit just calculates a little bit of this extra slope of these lines here. If you've got some wider wings, it'll make a bigger difference. And then you've got your probability of max loss. So the way that this one right now is built out, which might typically happen if you're just building out a position yourself, you may not even know that this exists, but if you build out a position here, you can actually pre-check and see if the metrics are good metrics for this potential trade. In this case, they're not. And the reason that they're not is because we've got negative alpha, which is negative adjusted returns, negative expected value. Our probability of profit is super low on this position. Our probability of max profit's low, and our probability of max loss is high. And you can see if we lose money, we're losing more than we make. So this would not be a good iron condor trade. But again, you wouldn't know that until you start building some of these out. Now, the cool thing that you can do here is you can start to adjust some of these wings and start to pull in these positions here and make adjustments to the payoff diagram to try and adjust these metrics here. This is if you're doing it manually. I'll show you a different way to do it that is a little bit easier and automated. But again, what a lot of people do is they just kind of mess around with these wings and they may or may not know some of these metrics. So as you adjust these wings and you go wider, you can see all of these numbers are changing as we go. And so we're starting to see a different payoff diagram start to evolve in front of us. Now, a cool thing about iron condors too is that you can actually do iron condors that are balanced. In this case, they're balanced like this. This would be a balanced position. It's an $8 wide spread on this side, and it's also an $8 wide spread on this side. You can see the payoff diagram is completely balanced because the max loss is exactly the same on both sides. But you don't have to do that. You can actually do iron condors that are called unbalanced or broken wing iron condors, as they're typically referred to, which means that one side could be shorter than the other. So this side is, for example, $5 wide, and this side has remained $8 wide. And that might mean that maybe you have a neutral bias, but you want to protect a little bit more of the downside. And so your downside premium or potential loss here is less than your upside risk. So maybe you're not as worried if the stock goes higher, so you're willing to accept more risk on that side. You're kind of more concerned if the stock goes lower, and you want to do you give that potential stock a little bit more protection. This actually might work well kind of in the environment that we're in right now, where we're recording this video, where we've had a lot of volatility. Most of that volatility is to the downside, so you might want to protect that position. Now, ultimately, as we're starting to mess around with these strikes, it might be hard to find positions that actually work number and metrics wise. And so this is a common problem that a lot of people run into when they start trading iron condors, is they either A, just don't know these metrics, or B, they can't find positions that end up working out as they're kind of messing with it themselves manually. So what we did is we created a tool to help you with finding trades that actually surface the trade ideas for you, so you don't have to go hunting for trades that make sense and meet the criteria. So inside of a tool like Trade Ideas, which is inside of Option Alpha, what we do is we actually analyze and go through and calculate all of these metrics on hundreds of thousands, millions of trade combinations every single day, every minute that the market is open. So you can see the market opened just a couple minutes ago, and it's already calculated and run through 700 and counting trades inside of Trade Ideas. Now, this is a different way of finding iron condor trades. Rather than you picking and choosing the strikes, you're going to surface those trades that make sense in this market. And if you can't find anything in this market, it means it doesn't make sense to trade that particular symbol right now, which is actually great. It keeps you out of bad trades, allows you to get into only the iron condors that make sense for you. So let's use Trade Ideas here, and let's actually find a trade in SPY. So we'll go here to open up the ticker selection here, and then we'll go to SPY, which is here. So currently there are 340 trade ideas in SPY, but let's start to filter this down for trades that make sense for us. So we'll use SPY. We'll go out a certain number of days. So we'll say like at least 10 days out. We'll do probability of profit of 60% in SPY. And so you can start to see how this list is starting to filter and whittle down. And this is really important here is like what we're doing is we're now telling trade ideas, hey, this is the type of trade that I want. I want a trade that's 10 days out. I want a trade that has a 60% probability of profit. And of course, I want a trade that has positive expected value. Now, this is actually the really important part here is that right now in SPY, there are no trades that price out to a positive expected value with a 60% chance of success or higher. And so that's really important. That's a benefit of using this is the ability to find trades that make sense, but also to avoid making trades right now when pricing maybe isn't the best for that particular symbol. So if you actually just click on some of these positions here, like iron condors, iron butterflies, you can see that you have the opportunity to make some money, but there's a really, really good chance that you lose money. And therefore, we calculate the expected outcome of this trade to be negative, which means you don't want to enter positions like this. So let's reset this a little bit and let's try to find something else, maybe in a different ticker symbol that meets our criteria. So we'll still use ETFs. We'll try to find some neutral strategies like iron condors. We'll go 10 days out, 60% probability of profit or higher. We'll set the expected value per contract of $5 or more. Let's make sure that we're at least 2% out of the money on either end for our positions. And we'll go with spreads that are no more than $5 wide. So we don't want anything super, super wide for a spread. And so now what we have is we have now a more filtered list of potential ideas. Again, this is going to update all the time, every single minute throughout the day. So this list could be completely different in a couple minutes. But you can see what it's already doing is it's already looking at all these different spread combinations for you for calls and puts for these iron condors. So in this example, TLT is kind of top of the list right now, but it's looking at the 100, 95, 85, 80 versus the 89 or 98, 95, 85, 82 versus the 96, 93 versus the 85, 82. So you can see it's just pulling all these different combinations, trying to figure out, okay, which one of these is pricing potentially better? How can you see all those different ones basically in one screen? So then if we go down here to risk reward, we can filter by risk reward or probability of profit. We can filter by alpha or expected value, whatever makes sense for you. Typically I filter by alpha, but also you can filter by risk reward as well and see if you can find some trades that make sense. So let's pull up this one here. This trade here is an interesting one. This one is a 81.86. So this one is $5 wide on this side and 90.95 on the call side. So this one's also $5 wide. This one has about 22 days from expiration. We've got our break evens. If we win $140. The probability of the max profit is about 40%. That's because we have a long sloping line here where we could get partial profits and partial losses. But the probability profit overall in this position is about 63%. Probability of max loss less than 10% at 6%. And the max loss, if we were to lose, is $361. When you take all of those numbers into the expected value equation, you get a positive expected value on this trade and positive alpha. It could probably be a little bit better risk reward trade for sure. But this is a trade that it looks pretty balanced, pretty neutral. The stock is trading right in between this range here. And again, the stock would just have to trade between 86.5 and about 91.40 or so for us to make money on this trade. So, all right, let's try to find some other opportunities here. So I'm actually going to switch this up just a little bit. But again, you can play around with this as much as you want. Let's remove the days to expiration filter here. And we also took the out of the money percentage for the short strikes into 1% or more. And we can find some other opportunities. So this one actually here looks pretty interesting. Pretty interesting trade here in GLD. This is a shorter duration trade. It's only 1 day, so it's going to behave and move very fast. But the numbers on this trade look a little bit better, and it's also a little bit less risk. So we're not taking the position for a long time, maybe better metrics and numbers, and not also holding it for a long time either. So this one looks like you could win about $46 and lose about $56. The probability of max profit, so much better at 58%. Probability of profit overall, 63%. Higher expected value, higher alpha, and a better risk reward metric as well. So it looks like a significantly better trade. Again, this is a great opportunity to find trades that maybe you didn't think about putting together in a combination of strikes. Maybe you didn't think about looking at these or looking at this expiration or these long strikes. And of course, from here, you can kind of tweak and adjust it if you want. Maybe you want to make it unbalanced or you want to widen out these strikes a little bit. But you'll notice that once you did that, it starts to really mess with some of the metrics of the trade. Not that it still can't be a good trade for you, but it's probably not the most ideal set of metrics. So let's actually go back to the original set, which was here, and see if we can maybe place a trade here. So I'll actually go ahead and place this trade in my account. Let's try to get this thing filled. We'll look at it while we're actually making this trade. So we can actually go down here to about 42. Looks like about 43 is about the place that we want to be. I'll place it into my live trade ideas bot, and then we'll go ahead here and place the trade. So hopefully this thing gets filled. If it gets filled, great. If it doesn't, we can come back in here later and readjust pricing. But it actually did look like it filled. It actually filled at 43, which is the price that I attempted it at. And so now I'm into this trade here, which has all of these metrics like we had talked about before. Pretty neutral position. Again, it's only 1 day of the actual position. So what we might want to do here is also set some predefined targets for exiting the position. And we can do that right here inside of exit options. Exit options run every single minute and kind of monitor the position automatically for you. So I could set my profit taking. Let's say I want to take a pretty quick profit on this, maybe 40% of the original credit. So if it gets to 40% of the original credit, let's go ahead and take a profit. And also I want to close this thing 1 hour before expiration tomorrow. So if it's going to expire tomorrow, I don't want to hold this through expiration. So 1 hour before, if I don't have a profit, go ahead and close the position. And I want to wait at least 1 day to avoid pattern day trading rules. So if you are in a small account, this is a great way to get into positions and ensure that you don't get the position wiped out and hit that PDT rule limit. You can just simply check that box right there, and it will wait to enter any of these position orders for exit options until at least 1 day has passed. So it's just going to wait till tomorrow to do any exiting or removing the position. But essentially, I can get this position taken care of and management taken care of right here using exit options, kind of mini automations inside of this position. So you can see the positions already moving around. All right, so last thing I'm going to show you how to do is actually how to automate iron condors completely. So we kind of went through a little bit of a hybrid process just now, which is that we found an iron condor ourselves, and then we set up some exit options to help manage the position. But you can actually go through the entire process of finding and entering iron condor trades using Option Alpha through automation. So what I'm going to do is I'm going to go over to one of my bots here that does this right now, just to show you an example. I'll go through 2 of these so you can see these. This template is actually already in the community. We'll put a link to it in the video below. You can clone this template, use it as your own, make modifications, changes, etc. But this is a monthly iron condor template. And basically what this bot template does, and it's set up to run live right now for me and it has been running, is it goes through a set of decisions to find an iron condor trade. So inside of this scanner automation, I'm basically telling the bot to loop through a certain set of symbols. In this case, I'm telling it these are the symbols that I want it to go through. There's a list of symbols that I've connected the bot to in my bot symbols here. And that just tells the bot, hey, look through these set of symbols that I'm willing to trade. These are acceptable symbols for me to trade, and open up a trade idea. And in this case, I'm specifically telling it right up here to open a trade idea. So essentially the exact same process that we walk through manually, I'm just doing it automated for an iron condor position. I've told it the symbol, I know what expiration I'm generally targeting, but I don't really care about the actual strikes themselves. I'm going to let the bot choose and filter and rank them based on my criteria as to the best symbols or strikes for it to use. I don't care if it uses the 100, 101, the 98, 99, whatever. It doesn't matter. Whatever is the symbol or the strikes that create the best position. And all I'm doing here inside of this trade ideas action is I'm giving the bot a list of criteria. It's like a shopping list, like a checklist. I'm saying, look, only enter a position if you've got enough capital and if you have less than 1 position with the symbol, which means don't keep opening the same position and the same symbol over and over again. Make sure that implied volatility is not super low, so it's generally okay or high. And then I'm also adding some position level criteria. So don't open a position before an ex-dividend date. Don't open a position where the bid-ask spread is super wide. And down here, I'm giving it very specific criteria that the alpha has to be greater than 5%, the expected value per contract has to be greater than $5, the risk reward has to be greater than 50%, and the probability of profit has to be greater than 70%. So if none of those things are true for any of these symbols, it just waits until there's a better opportunity to enter that position. I'm also telling it that the max loss per contract needs to be less than $300. So don't open a really, really wide iron condor that's got a max loss potential of $5,000. I don't want that. I want only things that have a max loss less than $300. Keeps everything very small and manageable for my portfolio. And then if you've got more than one idea, you can rank them by alpha and open up the top alpha trade, which is just a way to measure the expected value per unit of risk. So that's what I'm doing here. Very simple set of automations. And then inside of those automations or inside of those that criteria, I can use exit options to determine when I want to get out of the position. So I preset all of my exit options for this bot at 30% profit or 1 day before expiration. Again, the full trading cycle is complete, so I don't have to find the position. The bot can find positions that make sense for me and my portfolio, enter them, and then exit options takes care of the rest. You can also do some pretty cool things like inside this bot. This bot here is an expected value bot just set up for XBI. Inside of this bot, I run it a little bit different, which is that I'm checking some laddering criteria for spacing trades. I want to make sure I enter trades every couple days. But then I'm also checking my beta exposure, which I've gone through in a separate video. I'll link to that below this video here so you can check that out. I'm checking my beta exposure to see if I need to add a put credit spread or call credit spread or find an iron condor position. So you can see further down the decision tree here, I'm telling it, look, if your exposure is pretty good, you're not too bearish, too bullish, go ahead and find an iron condor or iron butterfly position. Again, in here, I'm doing a lot of the same checks here, but this time just slightly different here for these ones. If I have, I use this automation on a lot of different bots. So if I have a bot that's not an ETF, I would check for no earnings, no ex-dividend date, but a lot of the same checks down here. Expected value has to be greater than 10, risk reward greater than 80, probability of profit greater than 60, max loss 300. Again, ranking by alpha. So you can see I'm reusing a lot of the same similar concepts moving forward. And so what's cool about this is that when you start looking at these, it's managing the entire trading life cycle for me. So here it got out of these positions because they were at early risk of assignment, which I've programmed into my bots through my monitor automations. Here it just closed the position for a profit target. So you can see all of the orders are here inside of this dialog screen. So the contract was originally opened February 27th at 11:56, opened the trade for $1.09, and then eventually closed the trade for a 40% profit target at 65 cents. You can actually go into the automation log and see all of the criteria at that exact moment in time when the position was opened. So in this case, I can see all of the information for this position. At that time, the risk reward was 122%. The alpha was 33, my probability of profit was 61, my max loss potential was $90, the expected value per contract was 30, there was no dividends like that we had to worry about. So you can actually see the entire history and log and data and information for all the trades that you make. Again, this happened exactly at 11:56 in the morning. And so this is what we want from our trading strategies, right? We want to be able to find these opportunities and then execute them when they're present, because they may not be present right now or when you're looking, or you might be looking at different strikes. All right, so I hope you enjoyed this video on Iron Condor trading and Iron Condors 101. Hopefully it was a really good guide to getting started on Iron Condors. There's a lot to Iron Condors, but this hopefully got you 90% of the way there for understanding how they're set up, what the risks are, what the profit zones are, how you can find different trade ideas, and how you can start to use automation to surface newer trading ideas that maybe you weren't looking for yourself manually. If you did like this video, please let me know in the comments below, give it a thumbs up, and until next time, happy trading.